Hey, strategic wealth preservation investors, it's Chris Vermeulen from thetechnicaltraders.com with the quarterly report on the big picture of the economy and precious metals and where we think all this stuff is moving. Now, keep in mind, if you need your metals and need to pick some up here, strategic wealth preservation, amazing spot, and of course, flat rate shipping of only $50 to the US. Anyways, taking a look at the markets, let's look at a big picture view of where we are. Now, I touched on this in our last quarterly report. Long story short, we are in a stage 3 topping phase when it comes to most stocks, sectors, commodities, different assets. We are in a topping phase. Now, AI bubble has stretched the SP 500 and the NASDAQ to new all-time highs, which is fine, but it is completely masking the underlying weakness in the markets. And if we were to go down and look at the cycles that go through these markets, we have this blue cycle, which is the stock market cycle, and the gold cycle here, which is the or yellow cycle, I should say, is the economic cycle. Now, more or less, precious metals and energies tend to do very well near a stock market top. So do industrial capital goods. All three of these are doing actually very well, trading at or near all-time highs. And we see this happen usually a few months before the stock market falls off a cliff and starts to kick into a new bear market. And then we usually see the economy kick over a quarter or two later and give us the official reading that we are in a recession. Now, what's interesting here is we do have some unemployment starting to rise, which is interesting. This here is the government jobs as a percentage of total job openings. And what's interesting is the government's always trying to cover things up and make the economy can kick the can down the road, more or less. They're creating more and more jobs. And when we start to see the government creating lots of jobs, they typically know something bad is coming and they're trying to feed the economy. And we had the 2000 tech bubble burst, we had the financial crisis, COVID, and here we are, we're starting to climb again. And even though they're creating all kinds of jobs, the reality is unemployment, when we look at the 24-month moving average of unemployment, whenever unemployment moves above the 24-month moving average, which is where these red lines are, we go into some type of major recession in the market and a financial reset among most asset classes. And so that's what we're getting. We're getting more unemployment, even though the government's creating more jobs. And if we were to look at it kind of as a net of full-time jobs, you can see here, we really just started to see a lot of full-time jobs, people starting to get laid off. It's picking up speed. And of course, this typically happens just before we go into a major financial crisis in the markets. Now, the other thing that's interesting is if we were to take a look at excess savings in the United States, this was going right after or pre-COVID. We saw lots of people, early COVID, have lots of excess savings. Here we are now. People have burnt through their savings. People are tightening their wallets. There's rumors going around that we've seen peak sales for the SP 500, meaning companies keep downgrading and lowering their projections because people are tightening their wallets and things are starting to slow. So now we have people running out of money, living paycheck to paycheck more than ever, and this is not a good sign. Now, if we kind of carry things forward and take a look into the commodity space, this here is the commodity to equity ratio, and this is very good for precious metals and commodities as a whole. This is telling us we're pretty much at the lowest level or the most undervalued commodities have been for a very long time, or if ever, that at least is tracked here. And what's interesting here is this means we've got lots of room for commodities to rally. It also means that the stock market pricing is going to reset and come down. So if stock market comes down, even if gold and silver don't move anywhere, this ratio will move up just because the ratio of the value of stocks are going down. But this is telling us we are very close to a 2000 kind of tech bubble type of scenario. It actually feels very similar in a few different ways. And we have a typical or a similar setup as well in terms of the valuation, where really we're seeing real estate and stock pricing just super expensive, and commodities are considered undervalued compared to those. So that's what's pretty interesting. And a bullish picture for the precious metals space here's 71% of advisors have 0 to 1% exposure in gold. And, this means there's a lot of people that are going to need to start accumulating gold when the time comes. Eventually, we should see this 1 to 5% really get up to around this 71%. And then we're going to see a lot of people with this 5 to 10% portfolio holdings being even higher. This is what we saw. We saw somewhere around the 3.5%, 4% mark for the average portfolios back during the last major gold run near the peak. So there is a lot of room to move. And a lot of people had much more than that 3.5%. So that is going to tell us that once the shift starts and the general public and advisors start to get on the precious metals train, there's going to be a lot of accumulation going on. We're going to see precious metals do very well, but it takes a crisis to kickstart people wanting to move into this defensive commodity, this defensive type of play here. Now let's take a look at the chart of gold. This is the daily chart, and overall from a technical standpoint, this chart is very bullish, meaning we've seen price rally. It consolidated, kind of cleansed itself with a little bit of a purge. It's had another rally, a bull flag, another rally, and a bull flag pattern. Now this pattern is pointing to 2650 and 2750 for gold. So we have a very bullish case here over the next 2 or 3 months. I think we could see gold hit that level. When it comes to silver, I think we're going to see $34 and $36 silver. It has a nice bull flag pattern forming its way. It rallies, pauses, takes a rally, a pause, another big rally, and a pause. And this is pointing to $34 and $36 an ounce going forward, which if we were to bring that way back in time and take a look, let me scroll back even more, that is going to bring us right back into 36, into these highs from before. Let me just flip to auto scale. Let's go to the monthly chart and kind of get a bigger look in this area. So we have this potential for silver to have the second half of its leg, this 3-month rally, a pause, and it could push right up into this area of around 36 or so, dollars per ounce. So overall, very bullish case for the markets. If I go to gold and we see what happens during some market corrections, I believe we started a new bull market cycle in gold right over here in a super cycle in 2019, very similar to what we saw over here in early 2000s. And then the market worked itself and rallied up. And then we saw a multi-year consolidation. And then we saw gold and silver rally and break out after that pause as we went into the financial crisis. And that's what we're seeing now. We got a multi-year consolidation. Gold, silver are rallying up as a fearful defensive play because people see the music coming to an end when it comes to a lot of assets going down. And that's what we're seeing. I think we're going to see gold continue and silver to push higher. But when we do go into a stock market correction, we're going to see gold and silver have some type of pullback. So we could see gold and silver pull back roughly to the same price it's at now before potentially starting that next multi-year run to the upside where we see much, much higher gold and silver pricing for really the second half of this super cycle that should last 3 or 4 years after that. So lots of upside potential from where gold is right now. And I think we could see a very strong market for this space over the next 5 years. And it's going to be a battle to get your hands on physical. And that is the big thing. People say, you want to get physical. As soon as people want it, it seems like you can't get it. So I think it's very important to have physical metals, have it stocked or stored somewhere. Because when the time comes and gold is skyrocketing higher, you might actually not be able to get it. Even if you want to get it and pay the market value, you might not be able to get it. So it is important, I think, to hold physical. And I do. I hold a lot of gold and silver because I believe it's really an insurance plan and a hedge against some type of big crisis down the road and inflation going forward. Anyways, that's kind of the overall view of the markets. And if you like this type of analysis, you can always go to my website at thetechnicaltraders.com, and I share my ETF strategies for investing and things like that. All right, take care, everybody, and see you soon. Bye-bye.